Are you losing money? Hey guys, I'm Zach Sykes at Homestead & Co. And as a continuation of our real estate investing series, I want to talk a little bit today about entities, bookkeeping, things like that. A lot of folks get started in real estate investing and the numbers make sense to them about making more money. They start to analyze a deal, they really kind of understand the deal and they're starting to make some good money on it, makes a lot of sense. They sometimes can forget about those wonderful things called taxes. Taxes are always going to be there. So what can we do to minimize your tax liability? What can we do to keep you from paying so much money to the government and take advantage of programs they've written to encourage us to invest in real estate? Guys, let's remember that the government is people, right? It's people who wrote the laws and they understand, and I know sometimes they get a bad rap and sometimes they do some things really, really well. One of the things they've done really well is write the tax code in a way that encourages reinvestment back into the community. Owning real estate and owning real estate in the right way can have some significant tax advantages and is written that way on purpose so that it encourages people to reinvest back in their community and provide housing for folks. Guys, you gotta remember, yeah, we're trying to make some money on some real investing and some real estate stuff, but let's not lose sight of why we're able to make money on that. It's because we're providing a tremendous value, providing a great place for people to live, to raise their kids, to have their families. What we're doing as real estate investors and making nicer homes or flipping homes or preparing single family rental properties or multifamily rental properties or building homes, whatever it is, however we're investing in real estate. Guys, let's not lose sight that if we do it right, we can add back a tremendous value to the community by making it nicer and providing opportunities for people to live in great places. That can be a tremendous value add we a lot of times lose sight of. So the government knows that, and right, because the people know that, and the experienced people that are in the government know that. And so what they've done is they've written a lot of things into the tax code to encourage us to invest in real estate. This is a good thing. We're not taking advantage of the tax code by taking any loopholes, things like that. What we're doing is we're utilizing the incentives that are written there to reinvest back into the community. The biggest way you're taxed is if you make money and you don't spend it. You keep your money in your account. That's the biggest way you're taxed. When you reinvest it, you buy something else. You buy another property, you fix up a property, you reinvest. That's when you get the tax advantages in real estate. All of that starts with making sure we have it set up like a business. So first question I want to ask you today is, are you running your real estate investment company like a company, or are you running it like a hobby under your own name and everything else? Guys, real estate investing is a business. So it's our recommendation that you set up an additional entity. Now, I'm not an accountant, I'm not an attorney. Always go consult with your accountants and your attorneys and your other advisors. And yet here is what our understanding is and what we do and what we recommend to talk to your accountant or attorney about. Well, the first thing to do is actually create a legal entity, a legal business. You can do things like an LLC, a corporation, S Corp, things like that. Consult with your attorney or your accountant. LLCs are very easy to set up. You can set them up within a day and have an EIN number from the federal government. Those are things you need to go to your bank and open another bank account. So in Oklahoma, what we do is we can go to our Secretary of State website and actually file an entity to create a new LLC. Once you have those LLC docs back from the states, which by the way, guys, only costs about $100, you can go immediately on to the IRS website and register that entity with the IRS and get a federal employer identification number, or EIN or FEIN. What that allows us to do is now we've got an articles of an organization and we have an EIN number, and those two things together allow us to go open a new bank account. Now guys, what you're asking me, why do I need another bank account? Why don't I just open up my personal name? Well, guys, this is the business, right? And we need to keep business expenses separate from personal expenses. Why? Because generally our personal expenses are non-tax deductible and our business expenses are tax deductible. Now, why does that matter? Like, it's a lot of bookkeeping, it's a lot of numbers, it's a lot of detail work, and why do I want to go through all the tracking and understanding this tax code? It's boring, I want to fall asleep. So why does that matter? Well, let's do a comparison here, why it's important to know what expenses are tax deductible and which ones aren't. So let's say you had a $100 $100 expense on a rental property. Maybe your plumber came out to fix something, a handyman came out to fix something, and you paid him $100. So there's two different ways to pay that person, right? We can either pay them with their after-tax dollars, or we can pay them with our pre-tax dollars. Now here's where it gets interesting. On your personal income, you have your income, then you get taxed, then you have your expenses. On a business income, you have your income, you have your expenses, and then you get taxed. So what does that mean? If I have a $100 expense, that means that if I make $100 in my business, I can spend $100 immediately and pay that expense. So $100 gets applied directly towards that expense. And it only takes me $100 to spend $100. However, if I'm doing it with my personal with my after-tax dollars spending on that, so let's say, for example, I'm in a 35% tax bracket, I would have to make $153 after taxes. I have $100 left over, right? And then I spend it. So guys, you're losing a third of your money to the government by not counting properly. If you use your after-tax dollars to spend and invest in your business expenses, now true business expenses, versus keeping track of it in the entity. Guys, that is huge. That's a ton of money we're leaving on the table strictly because we may not be using appropriate accounting practices. What do we do? What are the practical steps to not lose that money? So for every dollar I earn, I use $1 versus I have to earn $1.50 to keep $1. So our first step, create that entity, get that legal entity set up, talk to your accountant or your attorney, have you get that set up if you want to. You can do it by yourself. The next thing we need to do is get those accounts set up. You can take your articles of organization, your EIN paperwork to your bank, your local bank, and get a business account set up. Right now that we have the business account set up, we need to have either an additional credit card for the business or debit card for the business. So anything that is tax deductible that applies towards that business goes on that account. Anything that's a personal purchase might go in your personal account. Remember that if anytime you're spending money or your resources on your business, that's tax deductible with the intention of using it on your business. When you're not, your personal things, it's personal. A lot of folks miss things that they don't, because they don't want to account for it, they don't understand the process that could apply towards the business. Why is that important? It's important because it's going to allow you to keep much more money in your pocket and allow you to reinvest that money back into those properties and investments. Okay, so we talked about expenses, right? The things that are simple, easy to look at, right? Next, I want to talk about one of my favorite things about investing in real estate for your tax benefit, guys, and that's depreciation. So how many of you guys know that when you go to buy a car, you brand new car, you go on the car lot, maybe you pay a good amount of money for it, and as soon as you leave that lot, now that car is automatically worth less because it's now used, right? The asset actually goes down in value over time. Now, the cool thing about real estate is that over the course of time, in any 10-year period, assets have always gone up in value. So it's not a depreciating asset, and yet the IRS and the tax code looks at it as a depreciating asset. So we can depreciate the property over 27 and a half years. So what does that mean? How do we do that a little faster? So let's say I've got a really, really big tax bill this year, maybe making a lot of money, got some money left over. I'm trying to figure out, do I invest it in a 401k? Do I do maybe a SUP? Where do I put this in some tax deferred vehicles to really save my money? Well, what we can do is we can put that money into a property. We can do what they call a cost segregation. Now, this is really important to work really, really closely with your accountant on this to make sure it's documented properly and done the right way. But essentially, we can look at a property, and there's lots of things in the property. We can do an accelerated depreciation on in year one, and then take the 27 and a half year depreciation and everything else. So what that'll do is it'll maximize your amount of buying power, that cash you have, by lowering your tax liability for money you're already going to spend on real estate or potentially another investment vehicle for yourselves. Here's what I want you to take away from that. So two of my favorite things about using real estate as an investment vehicle and lowering my tax liability, guys, is that the depreciation versus appreciation, right? The government says, hey, it depreciates, when in reality, it appreciates. We get a big value there. The second thing, guys, is if we've got a lot of extra cash sitting on the side, we have a high tax bill, we can use that cost segregation and accelerate some early depreciation in that first year to offset a big tax bill, allowing you to reinvest more cash back into the market and your local community. Both of those things not only help make you money, but they help add value back to your community, guys. And so these are good things we can feel good about doing and really helping your community out in a really, really positive way. Hey guys, I'm Zach Sykes at Homestead & Co. And thanks for watching.
If you were interested in more of that commission type, or you want to grow your commission, you're not sure how to do it, or you want to get into it, never been in it before, reach out to us. We're happy to sit down with you and explain how that works and guide you through that to put you in a position where you can invest in real estate.